Thank you, Professor and Sam, for those kind introductions. Introductions are kind of like Instagram posts. You only see the highlights. When you hear all those pleasing things, you remember, or at least I remember, that 99% of the journey that led to this moment is left out, and you don't get the full picture. I'm guessing you're all here tonight to find out how to turn $1 into $2 through investing, but jumping into that without giving you a more complete picture of what led to the track records that you heard about would be a disservice to you. What's more, it would feel dishonest if I didn't talk about some of the key inflection points and people that led me to be standing here tonight. So they deserve as much or more of the credit than I do for that introduction that Sam gave. So let me spend a few minutes on the journey, and then we'll get into the investment approach. This is Kathy. She's Irish, but found her way to Canada in the late 1940s. Kathy had a dream of being a nurse and worked hard to become one. She also had a real sense of adventure. She wanted to travel the world at a young age and did just that. She set off on her own in the 1960s as a travel nurse and made it all the way to Australia before returning to Canada to marry the love of her life. She settled in a small farming community in the eastern townships of Quebec with the dream of having a big family, and specifically, she hoped for 4 boys, and that's what she had. She claims that she willed her way into actually having 4 sons, in spite of that making her sound crazy. Anyways, I was fortunate enough to be one of those sons. Being her son was a lucky inflection point in my life. Specifically, she understood that everyone's an individual, that you really can't change someone. The most you can give them is freedom and positive nudges to help them discover what they're really good at in life. Without that freedom and those positive nudges, I would not have been a part of that track record that Sam spoke about earlier. This is Eva. She's Lebanese. She was born in the 1910s, grew up in the Great Depression, but never spoke a word about the hard times. No formal education to speak of whatsoever, but she knew how to work hard and was pointed in the right direction when it came to business. Like a lot of great business minds, she was just wired to understand it. Eva was my grandmother. She positively nudged me when I was 10. One day, it was just her and I, and she went into a safe and pulled out a bond. I didn't know what a bond was. She explained the concept, and it seemed pretty straightforward, but then the nudge happened. She explained the importance of reinvesting coupons. She walked me through the math of compounding. She understood the concept, but because she had taught herself about the power of compounding, she didn't know what to call it. She drew the math out on a piece of paper, and I was fascinated by the power of it. I was hooked from that point on. I never looked back. Without her positive nudge, I would not be a part of the track record in the introduction. This is Ugo, born in Rome and a proud Roman, graduate of Ivey. Ugo is the greatest study in contrast that the world has ever known, in my opinion. For example, his father looks like he walked out of a Hugo Boss catalog, and his mother looks like the most glamorous movie star you've ever seen, but for reasons unknown to me, Ugo has chosen a different style path in life. Anyways, on my first day of Ivey, I got lucky. My last name was Bousada, his last name is Bizarri, and students back then at Ivey were seated alphabetically. So we were seated beside one another. A few years later, we co-founded Timber Creek with a third partner. Timber Creek recently changed its name to Hazelview. Ugo's investment acumen has really contributed to Hazelview being the success that it is today and worthy of mention in the introduction. It's delivered positive returns over 25 years for investors, made a lot of investors a lot of money. Some of you probably pay Hazelview rent. They're actually the largest landlord in London, and they own a few of the buildings at the Western Gates. So if you do pay Hazelview, thank you for your business. If co-founding a successful firm with him wasn't a big enough positive nudge in my life, Ugo also introduced me to this guy. His name is Jeff. I've spent more time talking to Jeff than any other human being in my life. Jeff is an iconoclast. He's a fan of disruption. He understands business. He's a good man, and he's a great investor. We've worked together since the mid-1990s at 3 different firms. We co-founded EdgePoint together. To say he's positively nudged me would be a big understatement. Without him, there'd be no EdgePoint, never mind the track record in the introduction. Speaking of no EdgePoint, I don't think it would have existed either without this woman. Her name is Susie. She spent a lot of time on public health issues around the world, like in Western Africa eradicating guinea worm. She's raised 3 amazing humans, 2 of which are here tonight, and Susie excels at whatever sport she puts her mind to. Susie's my wife of 25 years and my deep love. I needed her trust 15 years ago to leave my job in the middle of the greatest financial crisis that I'd ever known up until that point. We had 3 babies at the time, and I was the only income earner, so it was a big deal. Without her positive nudge then and every day since, there's no way I'm standing before you tonight. There are countless others responsible for tonight's introduction. Pat Farmer is co-founder and CEO of EdgePoint and a great leader. Bob Kremble is also a co-founder of EdgePoint. He invented the approach that EdgePoint used to put up those pleasing returns and is one of Canada's most remarkable citizens. There's 13 other members on the investment team that work every day to put up returns for our investors. And there's 84 people who make up EdgePoint who try to do their best for the people who've entrusted us with their capital as well. I don't have enough time to go through all 84 of them, but 4 of my partners, Sydney, Rory, Ben, and Alan, are here tonight and have each provided positive nudges to me along the way as well. The bottom line is my life has been filled with positive nudges, and I'm grateful for them. When the professor asked me to do this, I figured it was an opportunity for me to potentially show gratitude by trying to positively nudge someone here. There's a good chance that I'm not going to change your life tonight. In fact, there's a good chance that most of you won't remember this presentation a few days from now, but there is a chance that I can positively nudge one person, and if I can do that, that one person will be better off. Not taking advantage of the opportunity to try would be a waste of the gifts that I've been given and the positive nudges that have come my way over time. At the very least, I hope I can influence you to reflect on the idea that successful journeys in life are born out of many positive nudges from others. So with that, let's get into the investment approach and how to hopefully turn $1 into $2. Imagine for a second now that I take away everything that you have in life. And in exchange for that, I give you a sum of money. We're going to call that sum of money a big sum of money. It's going to be $1 million. And I tell you, you have to invest that money to protect your future and those that you're responsible for. You have to buy a business with that money. Now imagine for a second that I show up and I have a business for sale. And I say, I want to sell you my business and I want to take your money. And you're going to say, well, as it turns out, I have to buy a business. Tell me a little bit about your business. And I say to you, the only thing that I'm going to tell you is that next quarter's earnings are going to be bigger than this quarter's earnings. And I'm going to tell you about the business, the industry, the competition, margins, revenue, growth. None of that matters. All that matters is that next quarter's earnings are going to be bigger than this quarter's earnings. By a show of hands, who in this auditorium would give me their money? Not one person, unsurprisingly. But it would surprise you to know that billions of dollars every single day exchange hands based on that investment approach in the stock market. It's got a lot of names, one of which is momentum investing. Now imagine I show up and show you a pretty little chart and say these 2 lines on my chart have just crossed. And historically, when these lines on my chart have crossed, it's been a good time for you to give me your money and for me to give you the business underlying this chart. And you're, of course, going to say, well, tell me, Tye, what does the business do? I'm going to say, that doesn't matter. All that matters is these 2 lines just crossed. Give me your money. By a show of hands, who gives me their money? Nobody, unsurprisingly. Tens of billions of dollars every single hour exchange hands on the stock market. Based on that investment approach. Lots of names as well, one of which is technical analysis. One more example. Imagine now I show up and I have a business for sale. I want your $1 million. I'm going to give you my business. And I tell you, the only thing I'm going to tell you is this business will double if interest rates go down, but it'll be a 0 if interest rates go up. Give me your money. Again, any takers? We have 1 in the auditorium. But again, would it surprise you to know that hundreds of billions of dollars exchange hands based on that idea every single day? The key point is what you would do if you were asked to engage your family's future in a business is exactly what we do day after day after day, month after month, year after year, which is say, okay, hold on, Tye. I do have money to invest, but what I want is I want a good management team. I want lots of revenue growth. I want defendable barriers to entry that's going to protect my margins. And I want all of those awesome things, but I don't want to pay for it. I want to buy it at a discount to what it's truly worth. Oftentimes in the stock market, you could find great management teams with businesses with phenomenal growth outlooks and great margin structures, but you're being asked to pay 2 or 3 times what it's truly worth. Who would want to invest their family's fortune in a business that's overvalued by 200 or 300%? It's a rhetorical question in this case. No one would want to do it. Neither do we. What we try to be is business owners that buy businesses. We're business people that go out and try and buy businesses. This can really be broken down into 2 elements. The first element is risk, and the second element is growth. So let's talk about risk for a second. If we went outside onto University Avenue, go over to Saugeen here and stop 100 people going into the residence, and we say to them, how do you define risk when it comes to the stock market? My guess is 100 out of 100 of them would define risk as volatility. And we think that definition is just plain silly. We think the true definition of risk when it comes to investing is the opportunity for permanent loss of capital. We approach each business as if it's the business that's going to feed our family and put a roof over their head. And you might say, oh, Tye, easy to say, tougher to prove. But at our shop, it's really easy to prove. Because the partners that make up our company, you saw a picture of all 84 of them earlier. Those partners have hundreds of millions of dollars of their own money invested in the same portfolios that we ask our clients to invest in. So when we buy a business, we're literally buying that business to feed, shelter, and clothe our family. So we approach risk differently. We look for real world risks. Risks to revenue growth and margin contraction, barriers to entry coming down, management succession, and risks to not knowing what you're doing. That's how we think about risks. We think about risk the way a business person would think about risk. A business person looks at risk and doesn't think volatility is risk. A business person looks at risk and says, the opportunity to lose my capital permanently is risk. And that's what we're focused on. Let's talk about growth very quickly. Growth is always important, but what we try and do is we look out into the future and we try to identify businesses that are going to be materially bigger in the future, say 5 years from now, than they are today, where we're not being asked to pay for that growth today. That's where the value part comes in. We're trying to buy growth businesses at value prices. So we are looking out and saying, how is this business going to look different? Now, there's 2 elements to this. The first element is we want to buy a growth business, but the second element is we want to buy it at a discount to what it's truly worth. The first part's a heck of a lot easier to do than the second part. If we ask this auditorium to come up with 20 names that with a high probability are going to be growing for the next 5 years, my guess is we could do that in less than 10 minutes and be pretty accurate. The much harder part is to figure out which of those 20 businesses in the stock market you're not being asked to pay for growth in. And that's what we spend the majority of our time doing. What we tend to do is we do what everyone else would say they do, which is we look for a good management team. We look for the opportunity to buy into a business that for whatever reason is going to grow materially in the future. And we're also looking for protected margin structures, high returns on capital, everything good about a business. And when I walk through it that way, I kind of make it sound like an easy recipe to follow, right? Something like a cup of good management, a cup of growth, half a cup of solid margins, 3 cups of knowing what you're doing, but it's not that easy. It can't be boiled down to a simple recipe. What it really is, instead, is we're looking to buy that future growth for free. And the only way to do that is to have a differentiated view about a business than the market. We call those differentiated views proprietary insights. What do we know about this business's future 5 years from now that's relatively unique to us? It's not reflected in the share price today. We believe this business is going to be twice the size, and we're able to buy that growth for free. So you might say, okay, how do we find our ideas? Well, the answer is it's very much a random walk. And these 4 dots on the slide are representative of 4 different years, let's say. The first dot represents a year 4 years ago where I might have been reading an annual report and picked up some information. 3 years ago, I might have been talking to an industry expert about a different industry altogether than the annual report I read about 4 years ago. And then 2 years ago, I was reading a newspaper article. And then last year, I read an analyst report. And all of a sudden, those 4 instances that are completely uncorrelated of knowledge connect and create an idea about a particular business and about how we could buy growth and not pay for it. What I define is very much a random walk. It's very difficult to put this into a recipe. What we're constantly doing is going out there trying to acquire knowledge and come up with proprietary insights, and we have no idea how those 4 dots are going to connect or if they're ever going to connect. But we're constantly on the lookout for them. Most humans are hardwired to dislike randomness. When we talk about finding ideas and it being a random walk, most people recoil at that idea and say, geez, that's uncomfortable to me. I want a recipe. Tell me the recipe. I wish I could. I wish it was that easy. But what I can do is talk about what other people do that I believe, or we believe, doesn't work. We don't believe you could run value investor screens and come up with ideas based on looking at low price-to-book ratios. We don't believe you could run momentum investor screens and come up with ideas that way either. We don't run screens for that reason. So outside of the random walk, how do we bring some organization to what we do? That's the big question. How does the random walk become repeatable? Well, the first step is to consistently use common sense. And I believe common sense is somewhat uncommon in the stock market. As per the example that I used earlier, all of that money that I used in the introduction, where I asked you to imagine that you had $1 million and I was trying to sell you businesses based on pretty little charts, or next quarter's earnings being bigger than this quarter's earnings, or rates going in a certain direction. All that, when I walked through it that way, it didn't sound like common sense for you to give me your money and for me to give you my business. But I talked about all these hundreds of billions of dollars sloshing around in the stock market. And all those hundreds of billions of dollars are there to literally feed, shelter, and clothe people's families in the future. But somehow, when you throw it into the stock market, people lose sight of that. So what we try and do is just use basic common sense. It's another way to say that we're just trying to be business people who buy businesses. And we believe that is an edge. Consistently trying to be a business person that buys businesses, day in, day out, is an edge. And we try and avoid, using common sense means also avoiding unforced errors. So what do I mean by unforced errors? There's a strong will in the industry to fail unconventionally on my side of the industry. And what does that mean? It means that you don't want to look too different from your peers, from your peer group. And the reason is what you're trying to do is manage your career risk as opposed to the real risk inside the portfolio. So what do I mean by that? I mean, if you're a portfolio manager and a certain number of companies, let's pick one company in particular. Let's say company ABC makes up 7% of the index. And you don't like company ABC. You think it's overvalued and about to go down, but it's 7% of the index. What ends up happening is if you're incentivized based on beating that index over 1 year, you're going to look at that 7% and say, geez, I really don't think I like this company at all, but I'm going to put 3.5% weight into this company. Why? Because the index is 7, and I don't want to be too wrong by not owning it. So what that person just did was they took money and they invested it in something that they didn't believe they should invest in. But they did it to manage their career risk, to not look too different. They wanted to fail conventionally because it was safer for them. Again, they're managing their career risk and not the risk inside the portfolio. I wish that this didn't happen very often, but we ran some research the other day. a couple of months ago, actually, and we looked at the top 53 global portfolios in the country. The reason we came up with 53 is I think we cut the limit off at any global portfolio that had less than $1 billion. And what we did was we looked at the top 25 names in the MSCI World Index. Just so you know, the MSCI World Index has over 1,500 names in it. And we looked at just those top 25. And if you look at 25 names divided by 1,500, you're somewhere around that 1.5% range. So that means those 25 names represented 1.5% of the index. That's it. But then we looked and we noticed that out of those 53 portfolios, 51 of them owned at least one of those top 25 names. And the average weight across those 51 portfolios in those top 25 names was over 15%. Those investors put $1 in $7 in those top 25 names, so they didn't look wrong. Again, managing what we believe to be career risk and not real risk inside the portfolio. What we would argue as not thinking and acting like a business person or using common sense. Using common sense, thinking and acting like a business person seems obvious, right? So that, I would argue, is the first step in the repeatability of this investment approach. This is one of my favorite quotes from Charlie Munger. Charlie Munger is obviously a famous investor, partner of Warren Buffett. He said, most people have an inability to learn from others. The proof is in the unoriginality of the mistakes made through history. It happens time and again. People make the same mistakes time and again, often unforced errors. So that was the first step. The second step I want to talk about revolves around some work that one of our partners at EdgePoint did a few months ago. What he did was he went back and he looked at a lot of our successful investments and tried to put them into buckets and say, is there some commonality amongst this? So that we could look at it and say, maybe it is more repeatable than the random walk. And he came up with some very interesting conclusions. He came up with the idea that there is a bucket called low risk, high uncertainty. And by the way, this investor's name is Andrew. He came up with low risk, high uncertainty. He came up with a bucket that he named marshmallow management. He came up with a bucket named quality upgrades and came up with one called the granny shot culture. And this is where we're going to spend the vast majority of the rest of the formal comments together. We're going to walk through each one of these buckets, and I'm going to walk through examples associated with each one of these buckets. So let's start with the low risk, high uncertainty bucket. So investors define risk the wrong way. We established that at the outset. They define risk as volatility, uncertainty. They don't define risk as permanent loss of capital for the most part. We define it as permanent loss of capital, and the vast majority of the market, for that reason, hates short-term uncertainty and volatility. So you could have a business that is a very good business, that's a low-risk business to own over the long term, but at the same time has a lot of short-term uncertainty, and for that reason, no one wants to touch it. So let me give you an example. I'll give you an example of something that I'm guessing at least one person in this audience has used once. Has anyone ever been to Spain? Just by a show of hands. Okay, so maybe 10 people. So you 10 people, there's a very good chance that you use this if you flew into Spain. The example I'm about to talk about is a company called Aena, and they own all of the airports in Spain. So if you go back to 2014 or so, the Spanish government was in trouble. What had ended up happening was like a lot of other countries, they had overbuilt going into the great financial crisis. And in this case, they massively overbuilt their airports as well. And what happened was they took on too much debt. During the crisis and subsequent to the great financial crisis and then the European debt crisis, they found themselves in need of money. They couldn't raise money in the public markets or it would have cost them a lot of money. So like a family would, that ran out of money but had assets, they looked around and said, okay, what assets are easily saleable to raise some dough? And they went out and they found this airport network called AENA. AENA controls 99.9% of all air traffic in and out of Spain. Now, we looked for that other 0.1%. It was hard to find. We think they own 100%. They just don't want to call themselves a pure monopoly. But for the purpose of this discussion, let's call AENA a pure monopoly. That was a very attractive asset for them to sell to the public. So what they did was during tough times in Europe and the European stock market, they went to the public markets and said, we want to sell around half of our business. And the stock market looked at it and kind of shrugged and said, we don't like this right now because the unemployment rate in Spain at the time was around 25%. Youth unemployment was almost 1 in 2 people. And there was a lot of fear, and back to that word again, uncertainty, high uncertainty in the short term. What we saw was something different. What we saw was 2 sides of their business. The first side was a regulated side. Airports are regulated because, again, they can be monopolies. And the regulated side could grow in the future if the number of passengers grew. And we said there's very high long-term probability that their passengers will grow as their economy recovers. So as their passengers increase, on the regulated side, their revenue will increase. And that will fall right to the bottom line. Everybody that flies pays an airport. You probably don't know that. It's buried in the ticket price. But there's a landing fee and a takeoff fee and all these other fees that the airlines collect from you and turn around and give to the airport. That's the regulated side of the business. And that's what we're talking about. So we looked out into the future and we said there's a very high probability that unemployment won't remain at 25% and that travel will return. Where things got really exciting, though, was on the unregulated side. Like I mentioned earlier, Spain overbuilt a lot of things, one of which was their airports. And by the time they took it public, they had massively, massively overbuilt their airports to the point that their airports, and for those of you that traveled to them a decade ago, you know this, their airports were extremely overbuilt to the point where they were operating on average at about 60% capacity utilization. Now think about this. If you own an airport, you have to heat 100% of it, secure 100% of it, cool 100% of it, no matter what. If capacity is 50%, 20%, or 100%, you have operating costs that you have to incur. So as you bring on more passengers, that incremental revenue has the ability to fall to the bottom line more quickly. But in this case, on the unregulated side, what was interesting was in a lot of these airports, they didn't even have basic things that you would expect to see in an airport, like a duty-free store. So they had all of this space, and they weren't using the space. Now, when you rent space on the unregulated side of an airport, what ends up happening is all that rental revenue, all that rent comes in as revenue and turns into pure profit, because your costs are already taken care of. You're already paying for the heat and the security, and the insurance, and all of that other stuff. So we looked at that and we said there's a very high probability that they're going to be able to do things in the future to this unused space on the unregulated side, and that's going to fall right to the bottom line. We got into the detail a little bit more, and we looked at the average profile of the passengers that flew through these Spanish airports. And we noticed that their incomes were very similar to the incomes of passengers that flew through Charles de Gaulle. And if any of you have ever flown through Paris and France, you'll know what the retail environment looks like at Charles de Gaulle. They have duty-free, they have fancy Louis Vuitton and Hermes, they have lots of food choices and all of that other stuff. All of that is rent that's being paid to Charles de Gaulle. And we looked at this and said, these airports have been massively overbuilt, and they're just waiting for the duty-free. They're waiting for the food selection or the fancy clothing stores to come in and pay them rent. Same passengers, at least economically, coming through. So there's no reason that they shouldn't spend the same amount of money that they spend at Charles de Gaulle. So there's a strong probability that they will in the future. Again, connecting dots over time. And we looked at this and we said, well, what are we being asked to pay for this? And the answer at the time was around 10 times free cash flow, which meant somewhere around a 10% free cash flow yield, which meant because these airports were brand new and they didn't have to deploy any of that capital back into the airports for a long time, if we own this, we'd be putting a 10% dividend yield in our pocket every single year for a monopoly that we believe could grow for two reasons. One, there was a strong chance that the economy was going to grow. On the regulated side, the economy would grow and unemployment would reduce. And on the unregulated side, we thought they would just do the basics, like rent out to duty-free, for example. And that's what they started to do. And in short order, the investment returned very pleasing returns for our investors that entrusted us with their capital. You can see when I walk through the business like a business person, you can see how this is a low-risk proposition from a quality perspective. This is one of the highest quality businesses in the world, a monopoly on air travel in and out of Spain. So you would say over the long term, especially given that they basically built out everything was fancy and shiny and new. So did it require a lot of capital in the near term? You could see how if you took a 5-year view, it's low risk. But in the short term, everyone was running away from Europe. 25% unemployment in Spain. We don't know. There's uncertainty. We don't know when the economy is going to come back. But a business person will look at that and say, that's opportunity. And that's what we did. So that's an example of the first bucket. Low risk, high uncertainty. Let's go to marshmallow management now. Andrew came up with this one because of the psychological study of marshmallows in children. Some of you have probably heard about this. And what you can do, apparently, the study shows that if you put a marshmallow in front of a child and say, don't eat this until I come back. And if you could wait, instead of getting one marshmallow, you'll get two. And of course, only a certain number of children are able to wait when you leave the room. But what they then did was they followed those children over time, and they discovered that the children that could actually wait when they were children turned out to be adults that were very successful in life because they were able to defer gratification. So the idea is extrapolating that from children to management teams. Defer gratification to increase long-term value. Now, I'm going to briefly talk about this example. This is a company near and dear to the professor's heart. We were talking about it at dinner tonight. The company is Fairfax, and it's a company that's owned broadly across a number of our portfolios. It's run by a gentleman by the name of Prem Watsa, who I know is very closely affiliated with this school. And I feel a little weird talking about it because he should be here talking about his own business, but I want to use Prem as an example of marshmallow management. So let me just very briefly describe the insurance business. Picture home insurance, for simplicity's sake, or auto insurance, for simplicity's sake. The insurance business is you saying, I'm going to bet I'm going to have an accident. I'm going to give the insurance company $100 today in the form of premiums, and that insurance company is going to give me back $95 in the future for accidents that I might have. And in the meantime, while they're waiting for me to have an accident, they're going to invest that capital while I'm waiting to have my accident. And they're going to keep all the proceeds from that as well. So the idea is not only do they give you back less money than you give them, I should say, at the beginning, but they make money on your money the whole period of time while you're waiting to have an accident. If it were only that simple, it's not. It's a very difficult business to do well. Fairfax is doing it very, very well today. There's two sides to what I just described. There's the one side where you give them $100 and they give you back $95 for accidents that you might have over time. That's called the underwriting side. And we're not going to talk about that side tonight. The other side is called the investing side. They take your money, your $100, and they invest it for the year. And that's the side I want to talk a little bit about. And how Prem and the team at Fairfax really demonstrated great marshmallow mentality. If you go back to a number of years ago, a lot of the competitors in the insurance industry were struggling to invest and earn a decent yield. Why? Because a lot of rates around the world were zero or trillions of dollars were trading at negative yield, as everyone in this room likely knows. And in order to offset those low yields, what most insurance companies did was they went out and they reached for duration, which means they reached for bonds that didn't mature for a very long period of time. Call it 7 or 8 years. The issue with doing that is when rates rise, bonds that are 7 or 8 years out into the future until you get paid back have their prices fall more quickly than bonds with short duration or that mature in 1 or 2 years. And what Prem did was he looked at that and he said, you know what? There's a probability that money isn't going to be free forever. Trillions of dollars won't trade at negative yields forever. And for that reason, I'm going to defer gratification. I'm not going to go out and buy an 8-year bond to earn a little bit more yield. I'm going to stay in the short duration stuff. And it doesn't yield as much as the long duration stuff, but I'm deferring gratification. And lo and behold, what happens is, as everybody in this room knows, interest rates all of a sudden go up because there's inflation around the world. And all of his competitors with long duration bonds all of a sudden lose a ton of money. Those bonds go down a lot in value. And when they lose that money, they can't compete for new business. And Prem and the team at Fairfax are sitting there with short duration money, 1 or 2 year bonds that mature. And he takes that money that matures after 1 year and now is investing it at much higher rates. So not only is the investment side growing very, very quickly from an income perspective, but all of his competitors can't write business and he can, which means he's gone out and taken a lot of market share. I believe the stat is that Prem, or Fairfax, I should say, was last year the fastest growing large insurance company in the world. Out of the top 20 in the world, they were the fastest growing one. And the reason he was able to do that was because he deferred gratification. Marshmallow Management and Fairfax. Let's talk about quality upgrades. Companies undergoing significant change that hasn't yet been recognized by the market. So back in the middle of COVID, in mid-2020, one of our partners named Derek came across a business named Motorola Solutions. So a lot of you might know the name Motorola for their cell phones. They sold that business off years ago. But what they were most known for at the time, back in the middle of 2020, was their land mobile radios. What the heck are those? Walkie-talkies that you see on EMS personnel, right? Firefighters, police officers, that type of thing. Why do they carry those and not cell phones? Because when you're in a burning building and you're in the basement and you don't get reception on your cell phone, that's not good enough. Land mobile radios work very well in that situation. So that's why EMS personnel use that equipment. There were two things going on at the time. First of all, COVID, and all businesses were under the cloud of COVID. But second of all, they had an issue with defund the police movement. And if police were defunded, then that meant that fewer people were going to buy land mobile radios because the police wouldn't have the money to buy them. So there was the second cloud over Motorola Solutions. And we looked at that and said, geez, okay, well, I guess there could be an idea that this defund the police movement won't take hold and the business will rebound. But that's not really a big enough idea. So we started looking deeper, and this is what Derek found. Derek brought these ideas forward. He said, look, this business has been investing for years in these other two areas. And these other two areas are massive growth opportunities. The first one has to do with 911 dispatch centers. There are more than 6,000 911 dispatch centers in the United States alone. And what happens when you call a 911 dispatch center is they take the call on one system. And the operator sits on the other side and transcribes your information and then has to go into another system to call either police, fire, or ambulance. and then has to go into another system after that and record everything so that it's documented in case anyone, like a lawyer, needs to look at that in the future, or a court. Very inefficient. And what Motorola was doing was they looked at this business and said, why is there 3 systems? It's so massively inefficient, and we can improve safety if we could integrate that all into one system, where the call comes in one system, you're dispatched out of one system, and the records are all done out of one system. And they designed that. They built it. And we thought it would take hold. That was exciting. But the really exciting part came from their video business. For anyone that's been to the United Kingdom, you really can't walk, or London, you can't walk 10 feet without being recorded on a closed caption TV video camera. And we looked at that and we said, there's a high probability that that trend is going to move across the world. You're going to have more video cameras in universities like this for security reasons. Schools, government buildings, office towers. And what Motorola did was they thought the same thing. But what they wanted to do was not only they not only wanted to make the video equipment, they wanted to marry it with intelligence, software. So that when there's a security guard sitting behind his or her desk and they were looking at 1,000 images, feeds of different video cameras, odds are that they're going to miss a person walking on a roof on one of those 1,000 cameras at 2 a.m. And what Motorola said was, why don't we marry our equipment with the software so that the computer can actually alert the security personnel that there's someone walking on that roof at 2 a.m. That the computer knows it's unusual to have someone walking on that roof at 2 a.m. and brings it to the security personnel's attention. And they invest in that. And we said, boy, that is going to be a growth business. First of all, you're going to want to have more cameras out there. And second of all, you're going to want to marry that camera with software technology. We looked at that and we said, that's going to be a big opportunity as well. We thought those 2 businesses could grow double digit. We thought the 911 dispatch center business could grow 10% a year, and we thought the video business could grow 15% a year. And we thought we were getting both of those for free into the future. What we did was we stepped back, again, connecting dots, and we said, here's an opportunity. So we bought an interest in a business, and what ended up happening was the 911 dispatch center grew at what we thought it would, at about 10% a year while we owned the business. And then what happened was the video camera business grew at over 30% a year for the years that we owned that business. And what we did was we then sold our stake in the business because we didn't see anything that other people didn't see at that point. We didn't have that proprietary insight, that unique view that a business person is looking for when they buy a business. The last one, granny shot culture. This is Wilt Chamberlain, and this idea is about the ability to do something unconventional and stick with it. In the 61-62 season, there was a game where Wilt Chamberlain scored 100 points. It's never been done again. In that season, he averaged over 50 points a game. Again, never been done again. Never. Michael Jordan, you name it. LeBron, no one's done this. How did he do it? Well, first of all, obviously extremely talented basketball player. But secondly, he threw free throws like this. And they called it the granny shot. Like a grandmother throwing a ball, I guess, is where they came up with it. Why am I telling you this story? Because people made fun of him. And when people made fun of him, he stopped doing it. And when he stopped doing it, his performance went down on free throws. He couldn't stick with it because it was unconventional. What's the example that we want to talk about as it relates to unconventional thinking? This is where we're going to talk a little bit about EdgePoint. When we started EdgePoint, we started it into an industry that was predominantly, and is to this day, predominantly marketing-led. If you go back in time to 50 or 60 years ago, a lot of the wealth management industry was founded by investors, and it was done for the end investor. So you had people like Sir John Templeton at Templeton, Bob Kremble at Trimark, Alexander Christ at McKinsey, Mr. Goodman Sr. at Dynamic, Mr. Goldring Sr. at AGF. And what they were doing was they were trying to build a company for investors. They were trying to do right by those that entrusted them with their capital. Their primary goal was earn a good return. And then what happened, not on average, over time, what happened was these businesses went from being investment-led to marketing-led. How did that happen? All sorts of different stories for each one of the businesses. But they all got taken over, and they went from being investment-led to marketing-led. What's the difference, you might be saying to yourself? There's a massive difference. There's nothing wrong with a marketing-led company or a sales-led company. But when it comes to investment businesses, we believe it's better to have investors in charge of those businesses because they put the interest of the end investor first. A marketing-led firm puts the interest of the shareholders of that marketing-led firm first. So what their goal is their primary goal is, in our opinion, to go out and gather assets. It's not to do right by the end investor. We had this idea, which a reporter actually called novel, if you could believe it, when we came out with it, to put investors first again. And we stuck with it. And we've done a number of things that are extremely unconventional in the industry. We didn't launch 50,000 different products in 10 different flavors each. We're not a financial supermarket. We took lower management fees. And if you stuck with us for 10 years, we gave you a fee discount to incentivize long-term thinking. We launched products where, in some cases, there are no fees unless we make you money. We tried to put the investor first in everything we do. And what was interesting is we stuck with it. Unlike Will Chamberlain, we stuck with it year after year, and we've been able to build very solid relationships with a very small group of investors across this country, or partners, I should say, small group of partners across this country who appreciate the granny shot, who appreciate doing something unconventional, who appreciate the fact that we put investors' interests first. And you might say, well, has that been a good investment? And it has been. At the beginning, the company was worth nothing. It was an idea. EdgePoint was an idea. And today, it's worth something. And it has so far been a good investment, and the onus is on us to continue to make it a good investment. And that only comes by continuing to do right for the end investor. So that's Will Chamberlain and the granny shot, and that's EdgePoint. So we've talked about how our definition of risk at EdgePoint is very different. We've talked about the importance of growth and thinking, acting like a business person. We've talked about the random walk of proprietary insights and how it's not easily put into a recipe, which would be convenient. We talked about historical examples that can be put into, for a lack of a better word, buckets. The low risk, high uncertainty, the marshmallow management, the quality upgrades, and the granny shot culture. And we've given you examples of each one of those. So that's really the investment approach in 30 minutes or so. I'm very happy to answer questions, but before I do, what I'd like to do is talk a tiny bit about the importance of diversification. I was talking about this with some partners earlier today here in London. A lot of portfolio managers like to come in and tell you about, buying a company for $1 and selling it for $2. Those stories can be exciting if you like investing. So, everyone has their Aena example, for example, or their Fairfax example. That's kind of half the job. The other half the job is diversifying the portfolio by business idea. What does that mean? It means that you have to diversify away from obvious correlations and non-obvious correlations. What's an obvious correlation? If we have 35 names in our portfolios, and 15 of them are banks. You're going to look at that portfolio and say, you're making a big bet on on banks. There's an obvious correlation here. What happens if your idea is wrong? Those are the easy ones to see, and they're much easier to diversify away from. The non-obvious correlations are a lot harder to diversify away from. They're what I like to refer to as real-world risks, what a business person would actually look at if they really own 10 businesses outright. And what they would be thinking about would be, geez, if oil spikes tomorrow because something bad happens in the Strait of Hormuz over in the Middle East, oil goes to $200 a barrel, which one of my 10 businesses here are going to suffer? Which one of them are going to do well if oil goes up? And if there's too much correlation on the suffering side, then you have to diversify more by business idea. A good business person would look at those 10 businesses and say, what happens if interest rates go from 0 to 4.5%? Which one of my businesses are going to be impacted negatively? Or which of my businesses will be impacted positively? An example being Fairfax, for example. This is what we do. So why do we diversify by business idea like this? We do it because we know that at least one of these 35 ideas, 35 businesses that we have, proprietary insights that we're investing behind, is wrong. We know we're going to make a mistake. And if you make a mistake and you have 50% of your portfolio correlated to that mistake, and that mistake goes down by half, you're going to lose 25% for investors. If you make a mistake and you have 35 ideas in it, each name is 3%, it goes down by half, you lose 1.5%. That's why we try to diversify by business idea. Away from obvious correlations, again, the easy one, and non-obvious correlations, like a business person would that actually owns businesses. So let me conclude now very quickly. Hopefully, tonight's discussion has positively nudged one of you at least to think about investing differently. I'm happy to answer any questions you have, but before I do, I'd like to thank the professor for giving me a chance to do this. It's a great honor to do this, so thank you very much.
Ask you while people are thinking about this. So you said that you don't screen, right? You don't screen.
We don't do screens, no.
But eventually, I guess, when you end up with 10 ideas,
Yes.
are you looking at valuation risk, I guess? Like, don't you somehow implicitly, you say, I don't want to invest in the idea with the highest price to book, let's say, or price to earnings.
Right.
Don't you implicitly look at the multiples?
Yeah. Well, multiples, certainly. So there's two parts to the answer. So how do we go about selecting a business? It comes down to our conviction in the proprietary insight. So we look at it and say, how much conviction do we have that we're not being asked to pay for this growth right now? So we look out 5 years and say, is this business going to be a lot bigger? And if we believe that, and then we can, we model and do things like that. What matters when it comes to modeling is the assumptions that go into the model and not actually modeling. But those assumptions, 5 years from now, we look at, and we see what the free cash flow per share, for example, would be of that business in 5 years. And we put a reasonable assumption on it of a multiple. So it might be, depending upon the business, let's say 15 times. And let's say we come away with free cash flow per share is going to be $2. And we say $2 times 15 times is $30. 5 years from now, what is the price we're being asked to pay for that business today? And if the price in the stock market today is $12, 12 to 30 over 5 years is a very pleasing return, so we'll make the investment. So the screen comes down to proprietary insights and our conviction around those proprietary insights. What do we think we know that's not already embedded in the market? What's the optionality that comes with the business if we buy it today that we're not paying for? Optionality being interchangeable for growth.
Thank you very much for coming to speak with us today.
Thank you.
My question pertains to Cimbria, and like in
Yes.
doing a little bit of a reading about EdgePoint, that came up quite a bit.
Yes.
I was wondering if you could expand on what Cimbria is, how that sort of plays into your day-to-day role, if like there's a difference between Cimbria and EdgePoint,
Yes.
and then why you guys actually decided to form that business entity in the first place.
Yeah, all great questions. Cimbria is a publicly traded corporation on the TSX that can own public shares of other companies and private businesses. So that's the very quick definition of Cimbria. You have 4 drivers of wealth inside Cimbria at that point. The first driver of wealth is people entrust you with their capital. You take that money and you buy publicly traded companies with it using the investment approach I just described. And we believe it can add value over time. So you're going to have that driver. In addition to that, we're vending in something that at the time, back in 2008, this thing called EdgePoint Wealth that had no assets under management, but we thought someday could have value. And because we were vending it at almost free, we're like, we could grow from almost free. And that will drive value if you buy these shares. So that's the second driver of wealth. It will appreciate in value. These shares of EdgePoint that we vended in should appreciate in value if we could deliver pleasing returns for the investors that entrusted us with their capital on the EdgePoint side. The third thing, or the third driver of wealth, was the idea that we're not making cars at EdgePoint, which means we're not capital intensive. So a lot of the free cash flow doesn't have to be reinvested in the business, which is a fancy way of saying that it could be dividended out. And Cimbria owned 20% or owns just over 20% of EdgePoint Wealth. So when EdgePoint dividends out $100, Cimbria gets just over $20 of that. And those dividends go in, and we take those dividends and compound them by reinvesting them in publicly traded companies or private businesses. And the fourth driver of wealth is because it's publicly traded, we said to ourselves, if it trades below its value, what we think the appropriate value is, we could go in and buy shares back. We have the ability to do accretive share buybacks. And we've done that over the years as well. So if you look at those 4 drivers of wealth, I could take you through the components in percentage terms of each, in terms of what they've delivered from a performance perspective, I should say, of each driver, but I'll just give you the bottom line. We've been able to take what was about $230 million and through performance and those 4 drivers, turn it into about $1.5 billion over the last 14 years. It's where we wanted to put our own money at the beginning. And it was created because we said, we're going to do this. And if people want to come along, they're welcome to come along. And we went out to friends and family and people that we had relationships with in prior lives, professional relationships with, and said, this is what we're doing with our money right now. Would you like to do this as well? And we found about $230 million worth of people who wanted to do it. And they participated for the most part, if they're still shareholders, in the growth. So that's a long answer. I could have just said, it's what we wanted to do at the beginning with our own. I should have just said, it's what we wanted to do at the beginning with our own money, right? And we asked people if they want to come along. But that's the truth. We had this idea. We thought it was an innovative structure, 4 drivers of wealth, and we thought we could grow our own money and wanted to offer it to others. And by the way, that's how we launch every portfolio. Our money's the first money in. It's not like we've launched a lot of portfolios, but for the first 4 years, we only had Cimbria and 4. For the first 9 years, we only had Cimbria and 4 others. And since then, we've launched 3. That's it. Thanks.
Hi there. Thanks for the presentation, by the way. My name's Rafi. So the question that I had was, how did you guys initially grow the money that you sort of kind of talked about? But after that, did you have like investors coming in and giving off equity for that? Did you have a portion of that happening as well to grow the business?
So at the beginning, we needed to raise money. There's 4 founding partners of EdgePoint. There's Patrick Farmer, Jeff McDonald, me, and this gentleman named Bob Kremble. Bob Kremble is our mentor. He's the founder of Trimark. And Bob had been in private life for a decade or so before we started EdgePoint. And we went to Bob, the other three. We went to Bob and we said, look, Bob, we think the industry has changed. We think it's marketing-led now. We think there's a need for an investment-led firm. And we'd like two things from you, please. We'd like your partnership. We'd like you to be our partner in the business. And we need a whole bunch of money is the second thing. And he thought about it for 24 hours and called us back. And we went down and he gave us the money. I mean, I make it sound simple. We had long-term relationships with Bob. He hired us all three of us had been hired under Bob's leadership a decade or more before. He knew that we practiced his investment approach, watched us closely for years, practiced his investment approach at his old firm, or at the firm that he founded. So he knew us. It wasn't like it was, an ask and a give, just like that. And that was the only capital that we ever raised from a venture perspective or like capital raise perspective. Does that answer your question? Yeah. And Bob, I should mention that Bob is not an active partner in the business, although it's the investment approach that he invented and taught us. He's always been a silent partner in the business. He's basically the financial backing at the beginning. Yeah, thanks. Thank you.
I'm curious to hear your thought process on position sizing and cash reserves.
The cash reserves is an easier one. Cash reserves is a byproduct of the investment approach, which means that we don't try and manage to a position of cash. We don't say, boy, we think the stock market's going to go down by 10%, so let's take our cash to 20% cash. We never do that. What a byproduct of the investment approach means is it means Motorola. Once the idea is played out and we don't see anything that the market doesn't see anymore, we sell our position in Motorola, whether we have a new idea to put it into or not, and then the cash goes up. As it relates to position sizing, it's a bit of an art and science, way more art, I would argue, than science. It has to do with our conviction level and confidence, relative confidence in the proprietary insight, relative to the risk of achieving that proprietary insight. So if we have very high conviction in the probability of our proprietary insights playing out, the ability to get that growth and not pay for it, and there not being a lot of risk inside the business, then we'll make it a bigger weight. Yeah, vice versa. Thanks.
Hi, I'm wondering if you could elaborate on the part where you said when you sold the stock after a year because you thought that all others have seen the same thing that you saw a year ago, and you thought that was the opportunity to sell the stock.
Right.
So just
Sure.
elaborate on that.
Yeah, thank you for asking that follow-up question about the approach. So it comes back down to proprietary insights. The way you make, we believe, the way you make money in the stock market is by seeing something different about the business that others don't. And we define it as buying growth and not paying for it. So what happens is sometimes when your ideas, not sometimes, the idea is for the ideas to play out, right? You want that growth to show up and you want everyone to get excited about it. And when they get excited about it, the share price goes up. And when the share price goes up, and you look at that business and say, okay, what do I know about this business 5 years from now that isn't being reflected in the stock market today? And you can't come up with an answer, you don't have a proprietary insight anymore. So you have to sell your position. You can't hold on to something without having a proprietary insight because proprietary insight is the edge. Right? It's the edge that you're going after. You're digging deep inside these businesses to see something that's going to lead to growth that the market's missing. But when it happens and the market sees it, the Motorola example, all of a sudden their 911 call dispatch systems were doing well, and video cameras were flying off the shelf. Everybody saw that now. When we bought it in mid-2020, people weren't even talking about it. They were talking about defund the police on the LMR radio side, right? And that created the opportunity to turn around and buy the growth for free. But by the time we sold it, everybody was talking about it.
First of all, really loved your speech. I'm just curious, kind of like, like once you find a company that kind of like meets your criteria, right? And, you put the capital in and kind of like, a few years have gone by. How do you like know, like, and let's say it's like underperforming and not meeting kind of the, the kind of perceived value you're expecting. Like, how do you know when it's kind of the right time to, exit, or like how do you kind of hedge that risk, and what's your kind of thought process to approach
I wish we could figure those out earlier than we do. I talked a lot about our successes tonight, and I didn't talk about our mistakes at all, but I wanted to point out that we publish all of our mistakes in a chronological order on our website. So if you want to learn about all the mistakes we made, with the exception of those in 2022, because we haven't published those yet, you could go to Google and put in EdgePoint and mistakes, those two words, and it'll take you right to that page. It's important that we highlight that. We talked about a lot of successes tonight, but we make our fair share of mistakes. So how do you know you make a mistake? There's extremes to it. There's something as simple as reading a press release, and when you read it, by the time you're done reading it, you know you've made a mistake, and you have to exit the position immediately. And at the other extreme, it could take you years to figure out that you've made a mistake. So let me give you an example of. We actually, I met with some external partners today, and we talked about these two examples. The first example is a business called Connaught. It was the first, I believe, the first big mistake that we made at EdgePoint back in 2009. And there are 5 million public housing units in the United Kingdom, and unfortunately there's demand for a lot more, which means those units are always filled. And Connaught had the idea of maintaining those units. Up until then, there were a lot of mom and pops that maintained them, and there were no economies to scale in doing it. Connaught comes along. I don't know if they invented the idea, but they were doing it well, of bringing scale to the maintenance of those units. And what would happen is as a family moved out, a new family moved in, you had to maintain the unit. Maybe the fridge needs replacing, or the carpet needs replacing, or while a family was still living there, maybe the door stops working, or the faucet stops working. So the mom and pops would go in, and when the faucet wasn't working, they would call a plumber and pay retail wages for that plumber. Connaught comes along and they say, instead of maintaining 100 units, we should maintain 2,000 units. And then we could have a plumber on staff and pay the equivalent of wholesale wages, because the plumber's always going to be busy. There's always going to be a broken faucet. So that's economies of scale, and we could undercut all of our competition, gain scale, and grow. And we said, boy, that's a good idea. And again, unfortunately, there's a lot of demand for the units. And then one day it's a UK listed business, and after the UK market closes, it's like 1 or 2 o'clock, and there's this press release issued out of the United Kingdom about how the government is going to the government is going to cut their funding for the maintenance of public housing. We had thought about that risk. We thought it was extremely low probability, because we thought when a faucet stops working, you got to replace the faucet. But I guess they found ways to cut, and they decided they were going to cut. It was in the great financial crisis. All the governments around the world were trying to figure out how to save money, and the UK government chose to do it this way. And by the time you finish reading that press release, you know you've made a mistake, because their revenue is about to decline, and decline a lot. So that's an example of a mistake where literally by the time you go through reading that press release, you figured it out, that it's a mistake. One where it took us a couple of years to get to the bottom of, Western Union. So everyone's familiar with the Western Union business model. And a lot of send points for money, a lot of receive points for money. And we thought the network effect was very strong, and we were buying future growth in that network for free. And we were wrong. This is what we missed, and it took us a while, like I said, to figure it out. What we eventually discovered was we thought the Western Union brand was very strong, and people would only want to send money over the Western Union brand because it was trusted. Because there was a lot of receive points when families wanted to send their money back home, it would be convenient for their families back home to receive that money to go to the local, wherever, Western Union store and pick it up. And that's the way the model worked for a long time, but here's what we missed. We missed competitors that set up competing businesses on only one trade lane, let's call it a trade lane, from point A to point B. Some city called point A, and you're sending money to point B. And what competitors did was they said, we don't have to have the scale of Western Union. We don't have to be a global brand. All we have to do is have an unbelievably strong brand that's trusted around city A, so that anyone who wants to send money to B can do it. And they have to make sure that they have that receive location in B. And they started picking off some of the most profitable competitors, started picking off some of the more profitable trade lanes. And we realized at that point, once we figured it out, that we'd made a mistake, but it took us a while. So there's no, it's hard to draw similarities between how quickly you could discover mistakes. It could be very quick or it could take a while. Does that answer the question?
Yeah, thank you so
Okay,
much.
Thank you very much.
Hi, Tye. Thank you very much again for coming. I just had a question about how you incorporate growth prospects into your valuation. You spoke a little bit about Aina, the
Yeah.
saying that you expected the regulated and the unregulated segments to grow 10% a year.
Well, I didn't talk about the unregulated growth side, but we thought I didn't talk about the regulated growth side, but the unregulated growth side we thought could have double-digit growth. Yes.
I was wondering how do you go about incorporating those numbers into your valuation? Are you actually projecting out your capital in the future?
Yes.
Back, or are you valuing the business as it is, as it stands, and then using that more of the business is going to grow eventually, we think, and that's going to be the catalyst of the price correcting in the market, and then you capture
The way we do it is we look at a business and we say, what happens if our proprietary insight plays out? And we go out in the model 5, 10 years, and we say, well, 5 years from now, if the idea plays out, right, the free cash flow could be this. And if half the idea plays out, it could be this. If none of the idea plays out, it could be this. And let's say the idea plays out in the version of the model that we're looking at, this particular version of the model. And we're saying, okay, the idea is going to play out 5 years from now. How much free cash flow per share do they have? And then we look at that and we say, okay, let's apply a reasonable multiple to that free cash flow, not an aggressive multiple, right? We're not going to assume that we've got to make a good sale to justify the investment. Let's place a reasonable multiple on that free cash flow per share 5, 10 years from now, right? And then we compare that price, let's say 5 years from now, to what is trading at for today. And we say, okay, is it up 20% or is it up 200%? If it's up 200%, you might have yourself an idea. That's how we do it. Yeah, we focus on looking out into the future and modeling it using our assumptions, but we try to do it with a range of potential outcomes as well. Does that make sense? Yeah. Okay, terrific. Thank you.
Thank you really appreciate your talk. So first thing is, studies usually show it's really hard to beat the market over the long run. So how have your portfolios performed relative to the market? That's my first question. The second thing is, in your speech you mentioned that you look for good management. So what does that entail? What do you guys look for within good management?
Okay, terrific. So I have to be very careful about talking about performance. As a matter of fact, let me just put this up. My legal department's happy now. I should have put that. There's one at the beginning as well that I'll put up. As it relates to performance, on a since inception basis across all of our portfolios, every one of our portfolios, let me go back. We launched with 4 portfolios that have been around for over 14 years. If you look at those 4 portfolios, which is the vast majority of the assets at EdgePoint, those 4 portfolios are all within the top decile of their respective categories. So they've been over 90% of their competitors. In 2 out of those 4 instances, they're the top percentile, beating 99% of their competitors. And they've all beaten their respective benchmarks on a since inception basis as well and added value. I don't want to quote how much value up here because I don't want to get it wrong because for the obvious reason. But we could you could go on our website and see all that information. It's widely available by portfolio over different time frames. So that's the first. Hopefully that's the answer to your first question. Your second question about what makes a good management team. I wish, again, there was a simple recipe to it. There is no simple recipe. They come in all shapes and, different forms. But some common characteristics, I would say, would start with people that are able to think long-term about their business. Because in order to grow a business, we believe you have to think long-term about it. You have to think 5 years. Where do I want my business in 5 years? How am I going to get it to grow in 10 years? And those managers are planting seeds today that are going to grow into big oak trees 5 and 10 years from now. So you'd be shocked at how few CEOs could stand up in front of a group of investors and actually talk about why their business is going to be much bigger 5 and 10 years from now. How incredibly incapable they are of framing the opportunity. So right away, that becomes, back to the professor's question about screens, that becomes a bit of a screen, if you will. If we do use a screen, that's the one. Can the management team even call out the idea, right? Can they talk about the idea? Can they frame the opportunity if we engage with them on it and show them that we know a little bit about the potential of this idea? The second common characteristic is the ability to deploy capital and understand capital. So what does that mean? It means a lot of people get to the CEO role because they came up through different ways. So they might have been, a really great marketer, for example, right? And they worked their way up from the lowest marketing position to the highest marketing position in the company. And when it came to choose a new CEO, they chose this person. And that marketing individual, no offense to marketing people, right? I'm not broadly saying this is true of all marketing people, but that marketing individual didn't have a background in allocating capital, and they don't understand capital allocation. So that happens more often than not as well. You'd be surprised at how few CEOs truly understand capital allocation and how few CEOs understand what it could mean if you actually own a growth business and your business, for whatever reason, is trading at 10 times free cash flow in today's world because people are worried about a recession or something. But your business is going to grow materially over the next 5 years with a high probability. They don't know what it means to buy their stock back. They don't understand the capital allocation. So we tend to invest in CEOs who understand that. So it's another thing that we're looking for in management teams. So the ability to think long-term, understanding capital allocations, those are the two common characteristics in a vast sea of differences amongst great CEOs. Hopefully that answers the question. I know I wish I could give you like 10 things, but those are two that jump to mind right now.
Great, thank you so much.
Thank you.
Thank you for coming to speak with us tonight.
Thanks for having me.
It was engaging and informative.
Thanks.
I just wanted to hear your thoughts on the cryptocurrency market.
Geez, like I'm a big believer in the technology that underlies crypto, blockchain. I'm a believer that that's going to change the world. I have some partners who believe in models, and they've educated me on how some of the models could work and how they could change potentially the economics of businesses. So democratizing capitalism, so where people get crypto for developing a new business, and the more value you add in that business, the more crypto you get, that type of thing. That's interesting to me. Have I ever personally invested in crypto? The answer is no. Have we invested in crypto in the portfolios? The answer is no. There's a wide variety of views inside our company about crypto. Our firm is not invested in it again. I'm closer to the view that I don't see, a good asset will grow in value. What makes a good asset grow in value? It's growth in that free cash flow from that asset, right? I believe that. We've talked a lot about that tonight. Why crypto isn't an asset that gives you free cash flow? In my mind, not in my mind, it's not. It does not give you free cash flow. So it's hard to see how that thing that doesn't exist is going to grow. Like there's not going to be more free cash flow in the future from this business, from that cryptocurrency. So for that reason, I have a very hard time valuing it and don't ascribe a lot of value to it for that reason. But you could have engaging conversations with some of my other partners at the office. But I don't think any of them are going to say, I don't think any of them would argue with the idea that crypto doesn't produce free cash flow, and free cash flow is what drives the value of a business. Thanks.
I'd like to ask the last question. I always ask at the end. What is the most important thing in running a business and in life that you learned over the last 20 years?
Two separate things, Professor, business and in life? Okay. Let me start with life first. The life one, I was very fortunate to go with one of my partners many years ago to go see a man named Charlie Munger, obviously Warren Buffett's partner. And there was a big auditorium of people listening to him. This is back when he was chairman of Wesco, when there was a publicly traded stub, so he had to give this meeting. And he sat there for about 4 hours, and at the end, someone asked him a question that had something to do with the meaning of life. And Charlie said something along the lines of, the happiest people I know are wired differently. He said, the vast majority of people work towards what they want in life. All their lives, they're after this goal. And he goes, the happiest people I know do it the opposite way. What they do is they figure out what they don't want and work to avoid that. And by working to avoid all of these things that they don't want in life, they wind up with exactly what they want that makes them happy. I thought that was super insightful. I was predisposed to be wired that way already. I wasn't smart enough to connect the dots like he did. But once he connected the dots for me, I've accelerated that part of my life. And I believe I'm much happier for it. He gave examples. He's like, in my first marriage, I think, again, I'm paraphrasing, but he said, in my first marriage, I figured make your wife happy. He said, in my second marriage, I figured out just don't make her unhappy. He said, the richest people I know didn't start out wanting to be rich in life. They just started out deadly afraid of being poor. The healthiest people I know didn't start out saying, I want to run a marathon. They just wanted to avoid being unhealthy. And he said, this is Charlie Munger saying this, so he knows some of the most amazing people in the world. So can certainly qualify as speaking about those individuals and those groups of people. So I would say that's by far and away the most important, impactful piece of advice I've received. Not directly, he was telling an auditorium full of hundreds of people, but I was privileged to be there. As it relates to investing, or business was your question, it's true of both. The most important thing is the insight. What do you see about this business that other people don't? And that could be true of a business that you're about to start up, or it could be true of what we do, investing in publicly traded companies that are already out there. We spent an enormous amount of time, I believe, tonight talking about insights as it relates to growth, but insights are equally important as it relates to margin of safety, which is words that I haven't uttered tonight, but should be uttered, should be spoken about. Margin of safety comes from the quality of the insight. So a lot of people thought, 2 or 3 years ago, they thought, I'm going to be safe and go buy a 30-year treasury bill. How did that work out for them, right? That was the exact opposite of safety. They got their heads handed to them from a return perspective. Had you done that as rates rose? It's not, what people classically define as safe isn't always safe, right? Where the safety comes from is having an insight about a business that other people, or an investment or something that other people don't. And if you can have that idea, then not only does it give you growth, but if the idea is right, it's very safe as well. It provides that margin of safety, the caliber of margin of safety that you truly want. So I think the most important thing to answer the second part is insights, for those two reasons. Thank you.